Today we will be looking at a 30-minute day trading strategy. Who am I? I am DP Roberts, and for years I've been testing hundreds of strategies and indicators, and I'm testing more every single day. I've compiled all that information into spreadsheets and used it to create a profitable trading strategy with a custom indicator. And we have an amazing community over on Discord where we help you become a profitable trader. If you are interested in getting access to the spreadsheets of all the indicators and strategies that we have tested, as well as a free trial to our custom indicator, you can just sign up for our Patreon down below. Alright, as I said, today we will be looking at a 30-minute day trading strategy. Before we do though, I wanted to put the testing scoreboard up for everyone to see. So to date, we have tested a total of 163 different strategies, with 60 of them being winners. The best one so far was able to achieve an 87% win rate. That was achieved using the Academy of Forex indicator. We've also tested a total of 995 indicators, with 420 of them being winners. As I said, today we are looking at a 30-minute day trading strategy. And so this is going to be kind of a recap and an update of the Academy of Forex strategy. And so even if you have the strategy or have seen the strategies, go ahead and watch this video anyways. So that way you can kind of have some updated information on what's going on with it. And so as you can see, we have the Academy of Forex indicator down here on the bottom of the screen, and we have an ATR candle tracking indicator down here at the very bottom, just kind of crunched down. That ATR tracking, of course, is used to identify kind of wild candles and wild candle spikes that we use in part of this strategy and the rules. We won't really go over that in this video, just know that it is a rule that is being used, and of course all these rules are outlined in the new video that I've done with an in-depth look into this strategy, which you can find here on the Patreon Strategy Academy of Forex Indicator Guide channel. Quite a mouthful. Anyways, so let's go over the strategy real quick and some of the differences. So now I went ahead and turned off the inverse Fisher transform line on my indicator. Again, all the settings are outlined in that same video that I just pointed out. Now we have the MR line here, which replaces any other indicator that we needed before. So now we just need the ATR candle tracking and the Academy of Forex indicator. No other indicator is needed. The MR line comes up now, and we're looking for that to go into the overbought and oversold position. When that happens, we're then looking for a sell signal or a buy signal. I'm going to streamline through this pretty quickly, because once you have access to the indicator, then you get access to the full guide as well. And so we'll just try to get to the numbers as fast as we can here, so that way you can judge for yourself whether or not it's a good strategy. So again, the MR line here breaks to the upside. We're looking for a sell signal. We picked that up right here. I went ahead and outlined our trade here that would be set up. We basically measure from the body of the signal candle up to the body of the last swing, and that's going to be our take profit number of pips. Then we're going to target right above this. In this case, I did an 8% above the wicks for the stop, and I did a 3% continuation. Now this is only going to be valid for the Great Britain pound versus the Japanese yen on the 30-minute time frame. As I've discussed before, it won't work on any other pair or any other time frame. Will invalidate those continuation rules. So we get the continuation push we're looking for, and you can see that we come down nicely, getting us to our take profit. We then get the MR line to the downside. We then pick up a buy signal right here, same setup as before. Again, these two would have been invalidated because we didn't get the continuation push that we are looking for in our rules. And so in this case, we do get that continuation, and we have a 40 pip take profit and a 59 pip stop, and we get to our take profit really nicely. We get the MR to the upside again. You can see that the MR is changing colors here from a greenish kind of dull color to these bright, vibrant colors. That tells you when it's breaking out to the upside or to the downside. We then pick up another sell signal here, and again, we measured out up to here. We have our stop set, in this case, a 40 pip take profit and a 68 pip stop. And so again, I won't go over the ATR tracking. These bright, vibrant bars are from the ATR candle tracking indicator, and that's used to identify, again, those wild candles and really long wicks. And so let's go ahead and go over the numbers, but before I do, let's go ahead and look at this comment left on one of the videos. And so this person says, I kind of jumped into the middle of the comment here, but the main takeaway here is they say, your strategy doesn't even have a 1-to-1 risk reward. I can scalp 2 pips all day, but unless I'm trading 100K every time, I'm making peanuts. I'm actually kind of disappointed. I was considering the indicator until I watched the video and so on. First of all, people like to scalp, and so they have decided to try to use this strategy on a 5-minute time frame. I never intended it for it to be on that low of a time frame. I personally wouldn't go lower than a 30-minute. That's not to say that it won't work, but at the same time, the number of pips are going to be reduced. Now, you're not going to get 2 pips per trade. That's just kind of a baseless claim, and we'll go over the numbers as a prime example of this and why having a 1-to-1 risk reward isn't necessary in this case. Let's just go ahead and go over some of these numbers here. So stay with me here. They might get a little confusing, but I'll try to walk through them the best I can. We did the 50 trade test like we normally do, again on a Great Britain pound versus a Japanese yen, 30-minute time frame. And out of those 50 trades, we had 40 winning trades. We had 10 losing trades, putting it at an 80% win rate. Now, what I did was I tracked every single trade, every stop, and every take profit. And over those 50 trades, the average winning pips, so for the winning trades, the average pips that you would have gained would have been 39 pips. So again, this 2 pips per trade is a baseless claim. And the average losing pips, so losing trades, the average number of pips would have been 56 pips. So you see that it isn't a 1-to-1 risk reward, but even with a 0.89 risk reward, you can see here that if we were looking to gain $585 per winning trade, our gain would have been $23,400. On the losing side, we would have been risking $840, and our drawdown would have been $8,400 for a total gain of $15,000 altogether. So you do not need a 1-to-1 risk reward to be profitable, and you can see how you're not just scalping 2 pips at a time, because you're getting a significantly better number of pips. Now, the Great Britain pound versus the Japanese yen is quite volatile and moves quite a bit. And so some of your other pairs, you're not going to get this quite this amount of pips out of it, and so just avoid trading this strategy on those particular pairs. Now, I mentioned in the response to that comment that I have outlined alternative stops, and here's an example of the alternatives. The alternative stops is on the Great Britain pound versus the Aussie dollar. I did again on the 30-minute time frame a test where I did 75 trades altogether. Out of those 75 trades, we got 58 winning trades, 17 losing trades. In this case, it was a 77% win rate on it. The total pips altogether in profit, the total pips would have been 1,655 pips altogether. Now, this is using the take profit and stop that I've outlined in the traditional method. Now, with the alternative stop, let's go ahead and just jump back and take a look at these alternative stop method. So in the alternative stop method, what you would do is instead of setting a specific take profit on this, in this case it was a take profit of 56 pips, what you're going to do is you're going to look for the MR line to break to the downside, and then the first candle to make a new high once that happens. A new either high or low, depending on whether or not you're in a long or a short. Now, in this case, you see here that we're almost at a 1-to-1 risk reward now because the MR line breaks to the downside, and this candle is the first one to make the new high, and you could even set a stop right above these right here, which is what I would have done, and just let it trigger you out when it makes that break. So you would have been at a 1 to 1.2 risk reward now using the alternative method. Now on this buy trade right here, the MR lines break to the upside right there. So we'll move this up, and in this case, this candle right here is the first one to kind of make that break to the downside, make a new low. And so in this case, you would have been at a 1 to 1.79 risk reward. And on this one right here would have been quite a monster of a beast here. So we break to the downside here, the MR line breaks down, and the first candles that start to make a new high are these right here. So let's just go ahead and drag this over and drag this down, and right there. In this case, you would have been at a 1 to 3.71 risk reward. So again, now this is going to reduce the number of trades that you take. So let's go ahead and go over these numbers real quick. So on this particular strategy here, when we did this test here, we had the 75 trades initially, but this time we only got 47 trades because you would have still been in some of these trades when these other ones would have taken place. So now you only have 47 trades, a 30% or a 30 wins, 17 losing trades, 63% would have been your win rate in this case. But you doubled the number of pips in this case using the alternative stop. And so you double the number of pips, but you only drop your win rate by 14%. It doesn't take too much math to understand this is a far more profitable trading strategy with far better risk reward. So again, this claim that a 1-to-1 risk reward, your strategy doesn't even have that. It does. It is plenty flexible to make up for these differences that people like to claim that it doesn't have the ability to perform correctly. And so, interested in the Academy of Forex Indicator, you can get a free trial to it when you sign up for our Patreon down below. After the free trial is over, it's only $15 a month to maintain the access to it. So it's super cheap for a profitable, efficient trading strategy. And as I mentioned a moment ago, I went ahead and I've done a full walkthrough video of how to use the strategy, how to set it up exactly how I have it set up visually and everything along those lines, and even give you a walkthrough of the guide to be able to interpret the information and the tests that I have done and so on. And so also, as you sign up as a new patron, you should get a welcome message like this, and it should also contain a video walking you through these links, how to gain access to the indicator and the free trial, how to get access to the Discord server, and then again pointing you to this video to use as a guide to set up everything exactly how I do it. So hopefully this should streamline from the very beginning all the way through to the point to where you can use this strategy efficiently like I use it. All right, that's it for this one. I'm going to go ahead and cut the video here.